Trump's tariffs have upped the odds of a US recession this year. Debt refinancing theories aside, this is bad news for everybody. But what if I told you that this isn't even the worst case scenario?
Worst case scenario. According
to some forecasts, stagflation is now on the cards. And it may sound goofy, but if stagflation bites, we'll be wishing it was only a recession. Today we break down what stagflation is, why it's so bad, and how likely this scenario is. My name is Nick, and this is a video you do not want to miss. With Liberation Day put on pause, it's back to the slammer for America until July. And if you listen real carefully, you can hear the sound of penguins popping champagne somewhere. Just kidding. Looking at the market reaction, anyone would think that the tariffs have been called off. But this is far from the case. The so-called reciprocal part of the tariffs, the part that was made up by ChatGPT, has been paused. However, the base rate of 10% slapped on the entire world has not. And this is still a seismic shift in global trade that looks like it's here to stay. Meanwhile, the US-China trade war is ramping up on what seems like a daily basis, with rates of around 125% on either side at the time of making this video. The White House has resorted to tweeting in all caps, "Don't retaliate and you will be rewarded," only to be roasted by China's US embassy posting memes about it. It's kind of funny, but it's also really bad news. China and the US together account for 43% of the global economy, according to the latest projections from the IMF. Slowdowns in both economies will have knock-on effects on the rest of the world, while the uncertainty created by Trump's pause is likely to deter corporate investment both internationally and domestically. The spiraling US-China tariffs have largely negated the relief implied by the pause on the other tariffs. Before Trump's pause, the average US tariff rate was set to reach 27%, the highest in more than a century. And after the pause, it has fallen to, drumroll please, 24%. Yep, and that's according to Yale's Budget Lab and Bloomberg Economics. So whatever doom and gloom you were feeling before the pause, you might want to resume. The pause has not changed the economic outlook all that much, and unless the US-China situation defuses, it could get worse, but apparently not for big tech, which recently got an exemption from the tariffs. Lucky them. Now, proponents of the tariffs mostly acknowledge that they will cause some economic harm, but justify this as a necessary step towards a greater good. As Trump said, the patient is very sick and needed some medicine. It's short-term pain in exchange for long-term gain. Let's talk about that for a sec.
Oh, sorry, I just had to take a break from that video to check the Coin Bureau deals page. You know, the one place you'll go to get exchange sign-up bonuses of up to $100,000 and trading fee discounts of up to 70%. Or how about discounts on hardware wallets, as well as exclusive altcoin alpha in the Coin Bureau Club? Well, more information in the description. Now, back to the video.
The tariffs are motivated mainly by trade deficit reduction and reshoring. Recent events suggest that the deficit issue is a shorter-term project, as the White House has said that many countries were quick to request trade negotiations after Liberation Day. Now, seeing as the base rate of 10% has not been removed, it may be a permanent fixture. But if these trade negotiations are to Trump's satisfaction, he can at least be expected to drop the ChatGPT part of the tariffs. And if things keep moving this quickly, some of the potential damage from these rates will be avoided entirely. Reshoring, on the other hand, is a much longer-term project. If tariffs are the tool needed to make it happen, they might be kept in place for years to come. Critics of reshoring cast doubt on its feasibility, time horizon, and potential for massive job creation amid rapid advances in robotics and AI. They point out that US manufacturing is still alive and well. It just doesn't need so many humans nowadays. Manufacturing's share of US real GDP has remained fairly constant since the 1940s. It is only the share of nominal GDP that has declined. And this means that the change is a function of prices. Allow me to explain. Manufacturing has become more efficient in the last 80 years, and the resulting cost savings have meant that the price of manufactured goods has increased at a slower rate than the overall increase in prices in the economy. So, US manufacturing output has not cratered, prices have, hence why US manufacturing accounts for a smaller share of the GDP. One of the reasons for this is because it's now possible to produce much more stuff with far fewer human workers. In other words, a lot of the job losses can be attributed to automation rather than offshoring. And this casts some doubt on the idea that US manufacturing jobs lost since the 1940s can be brought back, as it would likely require undoing automation. Well, jobs or no jobs, the US having more production capacity would surely be a win, if nothing else than for reducing dependence on external supply chains that could be subject to disruption. If the US can become more self-sufficient, that's a source of strength, no doubt. So when proponents of tariffs say it's short-term pain in exchange for long-term gain, we think this is what they expect to gain. Fair enough. But what about the pain? We've talked a lot about the effect on the markets per se. To recap, markets tanked to the tune of trillions of dollars, while the Fear and Greed Index for US stocks reached 4, indicating sheer terror among investors. Markets did indeed bounce after Trump announced a 90-day pause on non-China tariffs, but the tariffs can easily be slapped back on any country that doesn't satisfy President Trump, as was the case with Canada and Mexico earlier this year. Treasury Secretary Scott Bessent has downplayed the market damage by pointing out that most of the stock market is concentrated in billionaires' hands. In his portrayal, the government is, for once, putting the needs of the country above the interests of the wealthy. This is misleading because, for example, most pension funds are heavily invested in stock markets, so collapsing stocks means collapsing pensions. Billionaire stock portfolios can be dumped extremely hard without making their owners poor. The same is not true for retirees relying on the markets for their pensions. Moreover, the idea that the government was throwing billionaires under the bus has come into question, as the White House has been accused of market manipulation. We'll save that for another video, though. Anyway, potential trade disruptions aside, this short-term effect of tariffs was extreme fear in the markets, with very real consequences for working Americans. But if you thought fear was bad, I've got news for you. We might need to dust off the misery index soon. Yes, that's a real thing. Scared and miserable. America is going to need a good therapist. Now, for context, the misery index was invented as a measure of stagflation, a brutal economic phenomenon that is notoriously hard to break out of. The good news is it's quite rare. There have been occasional stagflation fears over the years, but the textbook case is still the 1970s. The bad news is that some economists are now saying that Trump's tariffs are likely to cause stagflation. So why is that? And what even is stagflation? Why is it such a big deal? And is this just some Trump FUD? Okay, let's start with the what. A stagflation is an unusual combination of economic stagnation, high inflation, and high unemployment. This is an unusual combination because demand dynamics normally push inflation and unemployment in opposite directions. When unemployment is low, employers compete for workers, driving up wages. Higher wages increase costs for businesses, leading them to raise prices. At the same time, more money in workers' pockets leads to strong consumer demand. So low unemployment drives both cost-push inflation and demand-pull inflation. Conversely, high unemployment slows wage growth as more workers compete for the same jobs. Increased joblessness dampens consumer demand, lowering price pressures. Makes sense, right? Now, this correlation, known as the Phillips curve, was first observed by the economist A.W. Phillips in 1958. It suggested that policymakers could trade off higher inflation for lower unemployment and vice versa. However, the limits of this model soon became apparent. In the mid-1960s, the UK experienced a period of simultaneous high unemployment, stagnation, and inflation, prompting one lawmaker to coin the portmanteau stagflation, a phenomenon that the Phillips curve model couldn't account for. A few years later, the same phenomenon would strike again, but on a much larger scale. In October 1973, the US sent Israel billions of dollars to support its military occupation of Syria and Egypt. Arab members of the Organization of Petroleum Exporting Countries, or OPEC, did not appreciate this. In retaliation, they cut oil production and embargoed exports to the US and other allies. The double whammy of a production cut and embargo caused the price of oil to quadruple while global supply fell by 7%. And this crippled industries dependent on cheap energy, particularly in the US, which depended on imports for 45% of its oil consumption at the time. So, a huge shock to the global economy. But why did this lead to stagflation instead of a standard recession? Well, let's see. The oil price hikes drove up production costs, resulting in higher consumer costs and pushing US inflation up to 12.3% by 1974. High inflation? Check. At the same time, the suddenly exorbitant cost of energy forced factories to cut output. Lower output meant layoffs, leading to the unemployment rate hitting 9% in 1975. High unemployment? Check. Incidentally, the misery index is the sum of inflation plus unemployment. So 12 plus 9 made the US economy 21% miserable. But what about the other component, stagnation? The technical definition of stagnation is a prolonged period of high unemployment, weak wage growth, weak productivity, and low levels of investment. All of these features were present, meaning the gang's all here. High unemployment, high inflation, stagnation, check, check, check. Now, why was this such a big deal? Well, it's because the tools available to central banks like the Federal Reserve no longer provide any good options. You see, normally, in times of macroeconomic stress, the general direction of the policy response is pretty straightforward. When inflation is running too hot, the Fed will typically raise interest rates. Increased borrowing costs cause households to rein in spending and businesses to scale back their investments. This means lower demand, and lower demand means less upward pressure on prices, so inflation cools off. The trade-off, per the Phillips curve, is higher unemployment. Most central banks deem this a temporary and necessary cost to preserve economic stability and living standards over the medium term. However, if unemployment is already high to begin with, the prospect of raising it even further to bring inflation under control doesn't look like such a great choice. So maybe the Fed should tackle unemployment first then, right? Well, in times of high unemployment, the Fed typically lowers rates. A decrease in the demand of borrowing stimulates demand, prompting employers to hire more workers, and therefore lowering unemployment. But wait, won't higher demand cause inflation to increase? You're damn right it will, and with inflation already very high, this is not a good look. What good is stimulating demand when prices are already running out of control? Unchecked inflation can lead to wage price spiral, where workers demand higher pay to keep up with rising prices, but businesses respond to increased labor costs by rising prices further. This feedback loop can theoretically lead to hyperinflation in the worst-case scenario. So, stagflation means you're damned if you do and damned if you don't. Faced with a choice between shooting itself in the right foot or shooting itself in the left foot, the Fed was paralyzed. It hesitated to raise rates aggressively, fearing job losses, and that's how inflation ended up above 12% in 1975. Believe it or not, it actually took another entire oil crisis before the Fed took decisive action. After the Iranian Revolution in 1979, Iran's oil output fell by 7%, sparking global panic and causing oil prices to double once more. Unemployment hit 7.5% in 1980, and GDP growth minus 8%. Once again, the Fed initially prioritized unemployment. However, the dreaded wage price spiral caused inflation to hit 13.3%. Newly appointed Fed Chair Paul Volcker eventually bit the bullet and chose which foot America would shoot itself in. The wage price spiral was causing runaway inflation, which could undermine public trust in the currency. Not a good look if your currency is the world's reserve currency. So, Volcker chose to crush inflation. He raised rates to 21% by 1981, the highest long-term prime interest rates have ever existed in modern capital markets. The plan worked, and by 1983, price stability had been restored, with inflation back down to 3.2%. But at what cost? Well, that's not a rhetorical question. Volcker's harsh medicine caused back-to-back brutal recessions in 1980 and from 1981 to 1982, when unemployment peaked at 11%. Ouch. It wasn't the Fed's fault that both raising and lowering rates could only exacerbate stagflation, but the resultant policy paralysis was devastating. Market expectations of inflation became de-anchored, and this is credited with embedding stagflation for a decade. Many lessons were learned from this miserable episode. The Phillips curve still has a place in macroeconomic theory, but it is now weaker and less stable than it was in the past. It's now understood that inflation is influenced by multiple factors, including supply shocks and expectations, not just the labor market. Monetary policy and, more importantly, the economy have changed a lot since the 1970s. We've had occasional scares and episodes of stagflation over the years, but the world has never again seen anything like what it saw in the 70s. But does that mean it would never happen again? We haven't seen another supply shock on the scale of the 1970s oil crisis. The price of oil quadrupling and then doubling is just bonkers, and few industries were left unscathed. However, Trump's tariffs, currently at a minimum of 10% on the entire world, are another once-in-a-generation supply shock. The shock is of comparable breadth because the tariffs are applied indiscriminately. But to be sure, it's a much smaller shock than the price of oil multiplying as it did in the 1970s. But remember, the most important country in the US's economic equation is China, and huge tariffs on China will mean a huge increase in input costs for US manufacturers, so cost push, inflation. An April 2025 survey by the University of Michigan has recorded 12-month consumer inflation expectations at 6.7%, the highest reading since 1981. At the same time, US manufacturers will be hit by production delays because they are dependent on Chinese rare earth metals, now under embargo. Output and jobs will fall as a result. And as we learned in Trump's first term, China's retaliatory tariffs can crash US farm incomes, exacerbating rural unemployment. Accordingly, the chief economist at Moody's Analytics projects US unemployment to reach 7.5% if the tariffs persist beyond 2026. Meanwhile, JP Morgan estimates tariffs could reduce the US GDP growth to nearly zero this year, and Larry Fink says he is, quote, petrified, and that he thinks a recession is imminent, if not already underway. So, stagnation, high unemployment, and high inflation. The gang is once again all here. It's a perfect recipe for stagflation. How bad it will get ultimately depends on how long the tariffs remain in place. Tariffs are popular with Trump's electoral base, but they are kryptonite to big business. And if the history of US policymaking teaches us one thing, it's that what voters want is irrelevant if it conflicts with business interests. The tariffs are an aberration, but at the time of making this video, it's looking increasingly like they won't last. As noted earlier, Trump is already making concessions. Also, unemployment may not be too big of a concern. In the latest data on job openings from February, the Bureau of Labor Statistics reported 7.6 million job openings in the US. The labor market is also much more flexible than it was in the 1970s, with the gig economy buffering unemployment. So, on the whole, tariffs all but guarantee some amount of stagflation, but that doesn't mean a decade of disaster like the 70s, which looks unlikely. Even if stuff starts hitting the fan in the trade war, history has taught policymakers to take decisive action quickly, as happened with the enormous pandemic stimulus in March 2020. Both the 1973 oil crisis and the 2025 tariffs were caused by political choices by the US, but the circumstances are completely different. And most importantly, the reduction in oil supply and massive increase in prices had effects that lasted long after the embargo was lifted in March 1974. Tariffs are different because they can be here today and gone tomorrow, just like those American iPhone assembly jobs. If Trump caves and tariffs are lifted, the situation is likely to improve immediately. A recession may still be on the cards, but that would be a walk in the park compared to a prolonged period of stagflation. Then again, Trump hates losing, and as one White House official put it, quote, he is at peak not giving a fuck. So anything could happen. Well, while you're waiting for this to play out, why not watch this video to find out why the US housing market could be next on Trump's hit list? And if you're not subscribed to the channel yet, you can do that right over here. That's me for now. Thank you very much for watching, and I'll see you again soon.